How is money created? In what mysterious ways does wealth come into existence? The big question we're told from a young age is that money is hard to come by. We're told that we should study and work our whole lives to earn it. But then, how can all this money suddenly come from nowhere? How is money created? Who's going to pay it back? What exactly does all of this mean, and what's going to happen next? In this episode, we'll explore the three ways that money's been created and some of the consequences that are going to happen. I'm also going to show you the true origins of wealth inequality. The first form of money is the one created by the government. In practice, it's outsourced to the central bank or royal mint, but controlled by the government. Physical money comes in two forms, either paper money or coins. This physical money is a tiny fraction of the economy, and in many economies, this kind of money only makes up about 3 to 8%. This physical money is created in order to meet the obligations of private banks. When you go to an ATM and try to withdraw cash, banks need to make sure that they have enough cash to meet those obligations. So, let's take a $10 note, for example. It costs approximately 3 cents to print this note. This means that there's approximately $9.97 of profit for creating a $10 note. This $9.97 is the government's revenue and is called seigniorage. Since the government makes a profit from printing and minting coins and can reduce the amount of taxation on the public, you might be thinking, why don't governments just always print physical money? The main reason that governments don't create the majority of money is because of politicians. If the politician running the office could create money at will, there would be a massive conflict of interest. There would be an urge to keep printing to fulfill campaign promises or fund wars. This would, in theory, destroy the currency by excessive printing, causing massive devaluation. The more money you have in circulation, the less it's worth. For example, if massive inflation takes place and the average Joe has $1 million, but that $1 million only buys an apple, how much is $1 million actually worth? The loss in purchasing power of money over time is called inflation, and when inflation gets out of hand, money becomes worthless. Some recent examples of runaway inflation include Argentina, Zimbabwe, and Venezuela. In this episode, we'll explore these concepts further. Inflation can quickly spiral out of control, causing people to lose faith in the currency. The government creates physical money, which makes up only about 3 to 8% of the money supply, reducing debt and easing the burden on taxpayers. The majority of money in circulation today is created digitally by private banks, accounting for about 97% of the entire money supply. When you borrow money from a bank, the bank creates the funds digitally in its account, and you are in debt to the bank. This debt then enters the broader economic system, allowing for more economic activity. Debt is essentially money, just from a different point of view. To the lender, it's an asset, while to the borrower, it's a liability. They are essentially the same thing. When a bank issues a loan, it's not using someone else's savings or existing money. It's creating brand new money by simply typing it into a computer. This newly created money is a digital representation of the government's money, which the borrower can spend. However, the beneficiary of this new money is the bank, as they get to charge interest on it, making a profit. When the loan is repaid, the debt and the money disappear, but the bank's profit from the interest remains. The real estate and property markets are significant tools for creating digital money because banks find it to be the safest and most profitable form of creating debt. If a borrower can't repay the loan, the bank can take the property, making it a secure form of lending. In developed nations, vast amounts of money are backed by the mortgage market. In Australia, for example, the banks have largely shifted their focus from investing in the wider economy to investing in housing. This has led to inflated housing prices as people take on more debt to buy houses they couldn't otherwise afford. This cycle has caused one of the biggest property bubbles on the planet. In addition to being addicted to debt as individuals and households, we also need to consider how our deposits in banks work. Once you deposit cash into a bank, you are no longer the legal owner of that money. The bank is. They keep 10% of your deposits on reserve, and can lend out the remaining 90% to someone else. This process, known as fractional reserve lending, allows for the multiplication of money across the banking system. Essentially, what we call a deposit is simply the bank's record of its debt to the public. When you deposit money, the bank owes you money, and it also records the money it owes you. Owes you is what you think you're getting as money, and that's all it is when all is said and done. An initial deposit of $100 with a tempest and reserve requirement can ultimately lead to $1,000 in total money circulation. Well, at least that was how it used to work until March 26, 2020. There is now a 0% reserve requirement according to the Federal Reserve. This action eliminated reserve requirements for all depository institutions. So, banks can now create infinite amounts of money with no reserves. And it doesn't stop there. When banks hold your deposit, they can, along with hedge funds, gamble with it through investments in financial instruments such as derivatives and securities. They do this in order to make superior returns. Most of the time, these instruments are basically just bets on if the price of an asset will rise or fall. But when taken to the extreme, it can get ridiculous. Remember the video where I talked about how they used financial instruments to bet on the weather? These crazy classes of financial instruments are what brought down the housing market and the subsequent global economy in 2008. But the problem today is that banks are playing with so many derivatives, sometimes stacked on top of each other with leverage multiplying factors, that nobody knows how much money is tied up in this gambling. Some estimates put the derivative market at over $1 quadrillion, over 10 times the global economy. In booms, everyone takes on debt, which is loans from a bank, and they spend it on things that they normally couldn't afford. But this causes economic growth. Eventually, people can't afford to take on more debt and can't pay it back. The banks stop lending, and defaults start to take place, and the economy takes a downturn. This is natural and has happened over centuries, but in 2008, everything changed. The world didn't want to go through the pain of a downturn, and some analysts mark this as the very point that the real economy died. In 2008, banks had become so large, intertwined, and integral to the supply of money that if you found this video helpful, don't forget to like, share, and subscribe for more insightful content. Until next time, happy investing.